You watch the price break a key level. You execute a trade in that direction, expecting a breakout. But instead of continuing, the market instantly snaps back the other way, completely taking out your stop loss. What you just experienced is a liquidity sweep. The market intentionally pushed past a structural boundary to trigger a cluster of stop losses, collecting the liquidity it needs to fuel a move in the opposite direction. To navigate these reversals, we can use a mathematical framework called the 2.6 pattern. Instead of guessing when a false breakout is over, this system calculates exact coordinates to pinpoint where the market is likely to bounce. By relying on a strict sequence of geometry and division, you stop trying to interpret every market move emotionally. You filter out the traps, wait for the calculation to trigger, and enter on your own terms. Let's pull up a gold chart and locate a clear structural high or low, where price action has completely stalled out. Look at this resistance zone. A candlestick wick pierces the dotted line, but the solid body retracts and closes below it. Notice how the next two candles attempt the exact same thing. The market is hitting a wall of opposing orders, gathering energy. Rule of engagement. If the market only prints wicks through this zone, you wait. Your signal is the wick-to-body break. Watch for a solid body to drop down and close decisively past the lowest point of the previous wick. Unlike those earlier candles that simply poked through and retreated, this candle commits. The body closes entirely on the other side of the structure. That solid close proves that momentum has actually shifted. The structural break is real, and it is time to calculate our exact entry point. To begin the calculation, immediately drop your chart down to the 15-minute or 3-minute time frame. This filters out the macro noise entirely. We need to measure the total distance of the structural shift we just witnessed. We will use two anchor points, the extreme peak that started the downward move and the absolute lowest point of the new structural break. Drag the price range tool from the swing high straight down to the swing low. It gives a raw measurement, 16 units. Now apply the formula. Divide 16 by our constant factor, 2.6. The result is 6.15. We translate that result back onto the chart to find our entry zone. Starting from the very bottom tip of the downward move, we measure back up by exactly 6.15 units. Draw a horizontal line exactly at that coordinate. That bright line marks the specific price level where we expect the market to bounce. Applying a rigid math formula gives you a single objective price coordinate. You no longer have to guess where the pullback might end. When the price returns to test that horizontal line for the first time, do not place a blind limit order. Before risking capital, you need to confirm that the zone is actually holding. We do this by waiting for a change of character on the lower time frame. Watch this chart morph from traditional candlesticks into a line chart, exposing the undeniable structure of the market. A change of character happens when price taps our calculated zone, bounces upward, and cleanly breaks through the immediate previous downward peak. Switch your view back to candlesticks and place a limit order exactly at the retest of that freshly broken level. Anchor your stop loss safely below the lowest wick. Stretch your take profit target up to the original structural high. Waiting for this specific sequence ensures you are entering a trade backed by confirmed institutional momentum, rather than trying to catch a falling knife. With your entry, stop loss, and target locked in, the process becomes hands-free. The math and structure dictate the trade from here. As the price action unfolds, the market dips perfectly into the entry point, stays well above our protected stop loss, and builds a clean staircase straight into the profit target. This system relies on three strict pillars: verify the wick-to-body signal, execute the 2.6 calculation, and demand the change of character confirmation before entering. Now it is time to put this into practice. Open your charting platform, navigate to a 15-minute gold chart, and backtest this calculation on the last 3 major market reversals. Do the math yourself and see the results.